Gold is suddenly back in the spotlight because money flows, markets, and geopolitics all point towards safer assets. With inflation fears lingering and real yields pressured, investors flock to a familiar hedge that has survived centuries of crises. Central banks have quietly expanded reserves, while exchange-traded funds see persistent inflows that push prices higher even when equities wobble. The result is a paradox. A metal that sits idle in vaults can still power huge confidence moves in portfolios. In practical terms, a $2,000 per ounce benchmark acts like a gravity well, pulling speculative funds and cautious savers alike towards safety and diversification. Gold functions differently from stocks, bonds, or crypto. It is a physical asset with limited supply, yet it behaves like a mirror of investor psychology. When confidence erodes or debt markets wobble, buyers turn to gold as a predictable store of value and a hedge against currency depreciation. In practical terms, gold does not grow corporate earnings or generate coupons. Its value comes from perception of risk and the desire to preserve purchasing power. Prices move with real rates, dollar strength, and global uncertainty, which means today's gold rally often reflects a balance of rate bets and geopolitical headlines rather than company fundamentals. Gold has walked with civilization for millennia, from ancient trade routes to modern central bank balance sheets. It survived the abandonment of bimetallic standards in the 19th century, the gold standard era, and the post-Bretton Woods era, where money moved on trust rather than metal. Investors remember that gold is not a fixed income asset. Its appeal rests on its scarcity, liquidity, and global recognition. The metal's price history includes multi-decade bull markets punctuated by sharp pullbacks, often tied to monetary policy cycles and crises that prompt hedging behavior across banks, sovereign wealth funds, and retail savers worldwide. Today, the market mood around gold is driven by flow dynamics more than corporate results. Exchange-traded funds have added hundreds of tons this year, lifting global gold held in trust toward record levels, while futures markets show back and forth between macro risk and seasonal demand. Jewelry demand in key markets remains resilient, but investment demand proves decisive when rate expectations swing. As central banks modify appetite for hard assets, gold prices test resistance near $2,000 and short-term volatility rises on headlines about inflation, currency moves, and policy surprises across major economies. Retail buyers also increasingly use digital platforms, expanding access beyond traditional buyers. People and companies across the value chain feel gold moves. Large miners like Newmont and Barrick adjust capex plans, debt management, and project timing in response to price volatility and inflation hedging preferences of shareholders. Jewelry retailers experience demand shifts when consumer confidence changes and cost of credit remains high. Sovereign wealth funds and central banks adjust reserve allocations, signaling longer-term demand for a safe asset. Asset managers re-weight portfolios, while retail savers use gold to diversify and preserve wealth through uncertain macro cycles. The net effect is a broad, cross-sector sensitivity to risk sentiment and policy surprises. Underlying dynamics hinge on macro terrain and geopolitical risk. A weaker dollar is generally supportive for gold, while rising real yields can restrain enthusiasm by offering competing yield. Today's backdrop includes divergent central bank paths, with some economies still easing while others tighten, creating a tug-of-war for bullion. War, sanctions, or trade frictions reframe gold not only as a safe haven, but as strategic ballast in currency reserves. Investor attention shifts to inflation trajectories, employment data, and policy promises as nations navigate debt burdens and currency volatility that can ripple into commodity markets and financial markets worldwide today. Smart money is actively reallocating toward gold amid growth uncertainty and policy risk. Hedge funds tilt allocations toward bullion futures and gold equities as a liquid hedge against volatility. ETF providers report steady inflows, translating into growing vault holdings and tighter global metal availability. Central banks continue to diversify reserves, occasionally signaling longer horizons for bullion, rather than short-term speculation. Retail investors access bullion and streaming platforms, boosting physical demand and digitized exposure. In short, the macro chorus favors gold as a portfolio ballast, while momentum players chase traction in volatility and event risk. Brokerage clients increasingly seek funds and notes that simplify gold exposure for diversified risk budgets. Every thesis has risks that could overturn gold's current halo. If real yields rise decisively or the dollar strengthens further, gold may struggle to sustain its advantage versus other assets that offer yield or growth. A material shift in central bank policy or a surprise decision to unwind reserve purchases could deflate prices quickly. Physical constraints in mining supply, while long-term, could reverse if project costs surge, yet manipulation fears and liquidity drying up during crises risk undermining trust. Finally, a broader market rally or AI-driven growth cycle could reduce demand for hedges, depressing safe haven flows. Significant. Retail investors can participate without overexposing themselves to a volatile morning trade. Start by defining a gold allocation that fits your risk budget, perhaps 2 to 5% of a diversified portfolio, then implement via low-cost ETFs or small amounts of physical bars for a tangible anchor. Use dollar-cost averaging to ride volatility rather than chase sudden spikes, and pair gold with assets that behave differently in crises, like equities or bonds. Watch liquidity and storage costs, choose reputable providers, and stay tuned to central bank signaling. Above all, avoid emotional swings and maintain a disciplined plan. Consistent. Looking ahead, the gold thesis remains tethered to risk, policy, and the pace of monetary normalization. We may see periodic pullbacks that test support near $2,000, followed by renewed bids as tensions re-emerge or inflation surprises reappear. The macro calendar will be dominated by central bank communications, inflation prints, and geopolitical headlines that can reset sentiment in days. For investors, gold offers a portfolio ballast rather than a sole strategy, a complement to growth assets and income for diversified portfolios. If you found this valuable, subscribe to the Commodity Brief for weekly insights on alternative assets and commodities.